September 2025, Saudi Arabia's public investment fund suspended construction on the line. There was no press conference, no statement to investors. The project that had been described as the greatest urban development in human history simply stopped. Workers were relocated, contracts were frozen, and the Saudi government's pre-budget statement for 2026, released shortly after, contained no mention of NEOM at all. By that point, more than $50 billion had been spent. 170 kilometers of mirrored linear city had been planned. 2.4 kilometers of foundation had been completed. The population target that was once set at 9 million residents had been revised, quietly and repeatedly, to fewer than 300,000. A project that was going to rewrite the future of urban living had become the most expensive construction pause in recorded history. This video is not an argument that Saudi Arabia is going bankrupt. It is not. The balance sheet has real assets, real reserves, and real institutional credibility. What this video is about is the gap between what Vision 2030 was described as and what the financial architecture behind it actually looks like when you read the filings instead of the press releases. There are 5 things on that balance sheet that the coverage consistently misses. Each one is connected to the others, and taken together, they tell a story about a transformation plan that was designed for an oil price that no longer exists. The first thing is what $50 billion actually bought. The line was announced in 2021. The original plan was a 170-kilometer linear city running through the desert of northwest Saudi Arabia. It would be car-free, carbon-neutral, powered entirely by renewable energy, and home to 9 million people by 2030. The construction cost was described at the time as approximately $500 billion. That figure has since been revised. A 2023 internal audit reported by the Wall Street Journal estimated the true cost of completion at $8.8 trillion, 25 times the annual Saudi government budget, with a projected completion date of 2080. What $50 billion bought is this: 6,000 piles drilled into the desert floor, each up to 3 meters in diameter, described by construction specialists involved in the project as among the largest piles ever installed anywhere in the world. 2.4 kilometers of foundation across a site that was supposed to stretch 170 kilometers. Several $billion in foundation work that now sits under sand, supporting nothing. A strategic review, still incomplete as of early 2026, is examining what aspects of the original concept can be salvaged and at what cost. In short, foundations, not a city. The Public Investment Fund wrote down $8 billion from its major project portfolio in August 2025. That write-down is a number. It is not an accident. It is an acknowledgement, disclosed through accounting rather than a press conference, that the assets backing those investments are worth less than what was paid for them. I spent time working through the Public Investment Fund's own bond prospectuses and the IMF's 2025 Article 4 consultation on Saudi Arabia to build what follows. The numbers are in those documents. The second thing is how the Public Investment Fund was financed. Saudi Arabia's sovereign wealth fund does not operate the way Norway's does. Norway's fund, the world's largest, holds no domestic assets and carries no debt. It simply accumulates oil revenue and invests it externally. The Public Investment Fund operates on a different model. It borrows. It issues bonds, sukuk, commercial paper, and syndicated loans in international capital markets. It uses the proceeds to fund giga-projects domestically and acquisitions internationally. In January 2025 alone, the kingdom issued $12 billion in sovereign bonds. PIF announced a $7 billion Islamic loan, and the finance minister disclosed a further $2.5 billion from 3 foreign banks. That is $21.5 billion in a single week. Saudi officials and their advisors describe this as precision finance, deliberate asset liability matching, long-dated bonds aligned to long-dated project timelines. That framing is technically accurate. What it leaves out is the dependency. The PIF's ability to borrow at favorable rates, it carries an A+ rating from Fitch and AA3 from Moody's, rests on the implicit assumption that the Saudi government stands behind the fund. The government's ability to honor that implicit guarantee depends on oil revenue. When oil revenue falls, that chain of dependency becomes visible. In 2026, Saudi Arabia's approved borrowing plan requires $57.9 billion in new financing to cover a projected deficit and maturing debt repayments. That is the largest annual borrowing target the kingdom has ever set. The third thing is the Aramco dividend and what happened to it. Aramco's dividend is not just a payment to shareholders. For the Saudi government, which owns approximately 81.5% of the company directly, and for PIF, which holds a further 16%, the dividend is the primary revenue transmission mechanism between oil production and budget execution. In 2024, Aramco paid total dividends of $124 billion. In 2025, that figure was cut to $85 billion, a reduction of $39 billion. The government's share of that cut was approximately $32 billion in lost revenue in a single year. The cut was not a policy failure. It was a consequence. Aramco's free cash flow in 2024 came in at approximately $85 billion, below the dividend it was paying. The company had moved into net debt for the first time in years. The performance-linked component of the dividend, which had been an additional payment on top of the base distribution, was effectively eliminated because there was no surplus free cash flow to distribute it from. At Brent crude prices below $77 per barrel, which is where the market has been trading, there is no mechanism that restores the performance-linked dividend without either higher oil prices or lower production costs. Neither is within the Saudi government's near-term control. The fourth thing is the fiscal breakeven gap. Saudi Arabia's breakeven oil price, the price at which oil revenue covers government expenditure, is estimated by the IMF and independent analysts at approximately $90 to $96 per barrel for 2025. Brent crude has been trading in the low to mid-$70s per barrel for most of the year. That gap, roughly $20 per barrel, is not a rounding error. At Saudi production levels of approximately 9 to 10 million barrels per day, $20 per barrel of shortfall translates to approximately $65 to $70 billion in annual revenue that the government projected but did not receive. The government's own 2025 budget assumed a deficit of $27 billion. By mid-2025, analysts at the Arab Gulf States Institute were projecting the actual deficit at between $49 billion and potentially 6% of GDP if spending was not cut. Revenue in the second quarter of 2025 fell 15% year on year. Oil revenue specifically had fallen nearly one quarter compared to the same period in 2024. Saudi Arabia was simultaneously the largest emerging market bond issuer in the first 5 months of 2025 and running a deficit that was widening faster than the budget had projected. Both of those facts are true at the same time. The bond markets are still lending. The balance sheet is still under pressure. The fifth thing is what the NEOM suspension reveals about the other giga-projects. The line was the most visible casualty. It was not the only one. Trojana, the planned mountain ski resort and host site for the 2029 Asian Winter Games, has faced repeated delays. Saudi officials are understood to be considering postponing the Games to 2033. Sindalah, a yachting island in the Red Sea and the only NEOM sub-project to reach something resembling an opening, held its launch in October 2024, 3 years late, at 3 times its original budget, and the event failed to impress the Crown Prince, who subsequently dismissed the NEOM chief executive. Qiddiya, the entertainment city near Riyadh, has seen contract awards slow significantly. The Red Sea project has continued at a reduced pace. In each case, the pattern is the same. The original timeline was built on assumptions about oil revenue and private investment inflows that have not materialized on schedule. The private investment assumption is worth dwelling on. Vision 2030 was not designed to be funded entirely by the Saudi state. The plan assumed that international investors would provide a significant portion of the capital once the projects demonstrated commercial viability. At NEOM, the commercial viability case has not been made. The resident population needed to make the economics of a 170-kilometer city work, density, retail, transport revenue, service infrastructure, requires millions of people who have not yet chosen to live there and have no clear reason to do so by 2030. The project was not just a construction challenge, it was a demand problem, and demand cannot be solved by drilling larger piles. Where does this leave the balance sheet? Saudi Arabia is not Greece, it is not Pakistan. It has $315 billion in foreign reserves held by its central bank. It has a sovereign wealth fund with over $1 trillion in total assets, the majority invested domestically. It has institutional access to international debt markets at investment-grade rates. The International Monetary Fund assessment describes the fiscal position as manageable, with debt to GDP at approximately 26%, low by global standards. That context matters. What also matters is trajectory. Every year that oil trades below the fiscal break-even price adds to a deficit that is being covered by borrowing. Every dollar borrowed now is a repayment obligation in the future. The 2026 borrowing plan requires $58 billion. The plan after that will require more, unless oil prices recover or spending is cut. The giga-projects were designed to generate the non-oil revenue that would eventually replace oil. They require oil revenue to be built. The logic is circular, and the oil price that was assumed when the logic was written no longer exists. I spent time on this because the coverage has consistently treated NEOM's suspension as an architectural story and Vision 2030's funding challenges as a macroeconomic footnote. Neither framing captures what is actually in the balance sheet. What is in the balance sheet is a transformation plan that was designed for $90 oil, funded at $70 oil, with a revenue engine that just had $39 billion cut out of it in a single year. That is not bankruptcy, but it is not what was advertised. If you found this analysis useful, subscribe. We follow the money that the news misses every week. Until next time.